Hello and welcome. This is Reema Tendulkar live from the TCS headquarters at Fort in Mumbai. We're awaiting the TCS Q3 numbers. Right now we have the bottom line with us. The profit is coming at 10,846 crore. That's a growth of 4% on a quarter-on-quarter basis, slightly lower than the 6.5–7% that the street was anticipating. On the top line, it appears to be a revenue growth of close to about 5.3% seen on a sequential basis. But the key numbers that we are awaiting are the dollar revenue numbers as well as the margin performance and an indication of what the future demand is going to be. So commentary around deal wins, hiring, that's going to be very crucial. Still short of details right now. Some statements coming in from the management. N.G. Subramanian, the Chief Operating Officer and Executive Director of TCS, says, as I look back at 2022, it's gratifying to see the privileged partnership that we continue to enjoy with our clients globally. In a hybrid working model, we've delivered many complex transformation projects tailored to the specific requirements of our clients' ecosystem with speed and agility. It's also refreshing to see our delivery centers and Paysport labs busy with consultants and client executives jointly reimagining solutions to deliver the future. The year also saw us embracing data, AI, ML holistically to disrupt ourselves and drive competitive advantage. All this augurs well as we step into 2023. Samir Seksaria, the CFO, says improved productivity, currency support and abating supply-side challenges helped expand our operating margins in Q3. This gives us greater confidence in our ability to steer our profitability towards our preferred range while continuing to invest in building newer capabilities to support our growth and market share gains. Those are some statements that we are getting. Milind Lakkar, who is the Chief HR Officer, CHRO, says our focus over the last few quarters is about bringing in fresh talent at scale, training them on new technologies and making them productive is paying off. We're particularly proud of having 125,000 TCSers at middle and senior levels who've been with the company for more than 10 years on an average. Just trying to get some numbers in. The operating margins for the company have come in at 24.5%. This is slightly less than what the street was anticipating. It's still an expansion seen on a quarter-on-quarter basis. The quarter-on-quarter expansion in margins is 50 basis points, but the street was anticipating a margin improvement of 70 to 80 basis points. So on the top line, there has been a bit of a slip. Order book for the company has come in at $7.8 billion, which is within the company's guided band of $7 to $9 billion, but it's lower than the $8.1 billion that the company had clocked in the prior quarter. Attrition has come in at 21.3%. Now, this is slightly less than what the company had seen in the prior quarter, which was 21.5%. Awaiting the top line number, the rupee revenue growth or the dollar revenue growth is about 13.5% seen on a year-on-year basis, but we still don't have the number on a quarter-on-quarter basis. So 13.5% is the company's revenue seen on a quarter-on-quarter basis. So those are the numbers that we have. The top line growth has crossed $7 billion is what the company has indicated. Just to summarize the numbers that we have right now, it's a constant currency revenue growth of 13.5% on a year-on-year basis. Margins have expanded by 50 basis points, but slightly lower than what the street was anticipating, a margin expansion of 70 to 80 basis points. The order book or the order wins at $7.8 billion is within the company's guided band of $7 to $9 billion, but it's less than the $8.1 billion that the company had seen in the prior quarter. The headcount addition has come down. The net headcount addition has declined by 2,197. Remember, since COVID, the company has always seen its headcount addition go up, but this is the first time we've seen the headcount addition come down. Attrition has fallen after 6 consecutive quarters of an increase. Attrition is now at 21.3%, which compares with 21.5% in the prior quarter. BFSI has seen a growth of 11.1%. So that's slightly slower than the growth that we'd seen in the prior quarter, which was about 13%. So there is some slowdown seen in the year-on-year rates for BFSI. Retail has been strong for the company at 18.7%. This compares with about 23% growth that they had in the prior quarter. Manufacturing is up 12.5%. In the major markets, North America and UK is up 15.5%. Continental Europe too has slowed down a bit at 9.7%. We've got Prakash, Diwan with us. Prakash, thoughts on the numbers?
So, I think Reema, the first cut there's nothing very spectacularly or remarkably great about the numbers, but it's kind of within the expectation band. Particularly, I think the revenue beat is commendable because there was expectation that there could be some stress given the cat amongst the pigeons that HCL Tech had released with the furlough data. So I think that hasn't really impacted TCS as much, is very clearly evident. But my sense is that the street might not be very excited, going ahead with this kind of a slip in the profit margins. I mean, the margins are good, but they're not as anticipated. So there could be a little bit of a nitpicking there. But I think what these numbers tell you is that things weren't as bad for the quarter. And more importantly, if the commentary for the quarter ahead or the year ahead as a whole is good, you probably have a very good second half calendar 23 is my guess. But these numbers tell you that it's hum and oh, it's not something very very different than what we had in the previous quarter to go with. Yeah.
Okay, we don't have the dollar revenue numbers, but a 13.5% constant currency revenue growth is largely in line with what the street was anticipating. For instance, Ambit was expecting about a 12.8% constant currency revenue growth. So TCS has largely delivered in Q3, but you would say there is no positive surprise that's come through. Prakash, the big question is really on the valuations right now. So TCS is trading at about 25.5 times forward multiple. It's off from its peak levels of 31, 32 times, but it's higher than the pre-COVID average multiples of 20, 21, going up to 22 times. So while Q3 has delivered this time, the fear is what the next few quarters hold, given the macro uncertainty. And there is a risk that revenue estimates will scale down. The deal wins that the company is reporting right now are the deals which have been in the making for the last few quarters. Perhaps it's only in Q4 of FY23, Q1 FY24 will we start seeing the deal wins slow down if indeed the tech budgets are tightened and are flat. So your thoughts on valuations, and if there is no positive surprise in the numbers, how do you think the stock will react? What's the positioning like?
So, I'll take the latter part of your question first, Reema, because on Monday during the trading session, I think the market built up the expectations given that there was nothing much that could go wrong in Q3 for some of these larger numbers. And especially, TCS was playing more of catch up with Infosys in terms of crossing that revenue mark. It's something where, they did, sound positive in the last commentary itself. And Q3 is more of a continuation of execution of the same contracts that you have for calendar 22. So there's really not much to upset it, except for if the furloughs were to hit them, as I said, which doesn't seem to be the case. Going forward, if you look at the 29, 30 times bands that, we've seen on the higher side at times, even currently, the valuation is not something which is very attractive. So from a risk reward perspective, the risk is more on the downside than the upside. Even if they deliver, or there is an improvement in margins, or there is a continuation of order wins that is impressive, which is seeming to be more like if everything goes off well in the US, they'll probably do as well as they did in 22, but not maybe better. So that's what you're penciling in, that even a status quo of sorts on the book, on the win book, it's good enough for these valuations. But anything less than that, and the valuations could hurt. So that's my guess. You'll have to give it this first 2 quarters without really getting exuberant about anything, unless, as I said, the commentary comes up with something which we don't know of, or which the management is visualizing in terms of envisioning much more strongly going ahead. But I think the valuations are fairly, the stock is fairly valued. So from a positioning perspective, you really don't have to add anything to the portfolio at this juncture. It's not in that attractive zone. You'd probably have, as I keep on saying, more of the likes of Tech Mahindra and all, which probably have an optionality or an upside attached, which you would look at, but not TCS for sure.
Okay, now we have clarity on what the company's revenue numbers look like, and there is a beat on the top line. Dollar revenue growth has come in higher by 2.9% on a quarter-on-quarter basis. This compares with the CNBC TV18 poll of 1.6, 1.7%. Even in constant, even in constant currency terms, it's a growth of 2.2%, again higher than the 1.5% that the street was anticipating. So to summarize the Q3 numbers, revenue beat, margins miss, deal wins have slowed down on a quarter-on-quarter basis, but within the company's guided band. The only negative in the number, perhaps, is the fact that the hiring for the company or the net employee headcount has declined by nearly 2,200. One of the reasons could be the fact that the attrition is also coming down. Attrition for the company is lower after 6 consecutive quarters of increase. So now that you have fewer numbers leaving the employee, the TCS, fewer numbers leaving the TCS workforce, therefore there are fewer people that you need to hire to replace them. The backfill attrition. So that's one of the reasons. But very often, the street also sees the hiring numbers as a proxy for future demand. Moshe Katri is with us. Moshe, revenue performance is very strong for the companies, 2.2% on a constant currency basis. Considering that this is a seasonally weak quarter, HCL Tech had already flagged off higher furloughs in many verticals, and the street was worried about longer decision-making cycles, a cutback on discretionary spend. How would you read the top line? And would you look past it, saying that the next few quarters could still be muted given the macro uncertainty? Or would you read this as the trend on what we should expect?
This was never about the quarter itself, as you know. I think the numbers were expected to be pretty strong just because the budget's already set. HCL Tech is probably more company specific, given the fact that the company does have a lot of exposure to the high-tech industry. That's number one, where that's where we're seeing some weakness, obviously, given some of the furloughs, and obviously because of their IBM because of their IBM assets that they've acquired a couple of years ago. But in general, I think it's going to be more about what happens beyond the December quarter. We continue to see, I would say, very fluid situation in terms of spending decisions. The budget cycle, that's probably going to be set a bit later than usual. So you're probably going to have a slower than usual March quarter. And after that, you may see, an improvement from there sequentially. But the quarter, in my view, is pretty much in line with what we thought it's going to be. And it's more about what happens beyond the December quarter at this point.
So you're expecting a weak March quarter. What about a June
we're
quarter?
expecting
How long do you think this weakness could last?
So I think we're going to see what we've seen during the prior down cycles, where budget decisions probably going to see a slippage, maybe by about a month or two, because of the macro. You're definitely going to see a moderation in budgets. The good news is that the street is already factoring that in expectation. So Street's expectations for fiscal 24 are roughly 10-11% growth for the sector. That's easily 50% moderation. And obviously, this factors what we call a soft landing scenario.
I was just looking, Moshe, at the Nomura estimates, and they said revenue growth for TCS was 15.9% in FY22. This is likely to come down to 7.5% in FY23 and further moderate to 5.3% in FY24 before improving in FY25. So street expectations have materially, come down in the last 6 months. So the first leg of the decline that we saw in the IT names was on the back of margin misses. Then it was on the back of a PED rating that we saw due to higher interest rates. And in the last 3 months, the EPS cuts we've seen some EPS cuts, which have also resulted in some down cycles. What would be the read-through for the rest of the sector, Moshe?
I think that, again, you have to make certain assumptions about where this macro is going to lead us to. I don't have a crystal ball, but there are some interesting scenarios here, right? So first of all, the financial services sector, which has been very, very weak during the last downturn, I'm talking about 2008, seems to be in a better position now. So that's a good thing. This is really a macro that's driven by Fed decisions more than anything else. And that's why I call this a very fluid situation. And that's why it's really difficult to play the 2008 market crash kind of playbook. And so you have to make certain assumptions about how severe the downturn is going to be. Is it going to be a soft landing? Is it going to be a hard landing? Going from mid-teens growth to 5% growth year over year, that sounds to me like a very severe kind of downturn. And I don't know if you're here yet. So that's why, the way I see it, that 10% growth that the street is looking for, at least based on what I see it here out of the US, seems to be a bit more realistic. But again, we're going to have to wait and see how the budget cycle is going to look like, how the macro is going to look like. The numbers out of the US last week, especially the employment numbers, continue to look fairly okay. So, that's why I think it's really difficult to come out and make that call about where the global economy is going to be. And obviously, this will impact spending. It is a fluid situation, and the December quarter, is not really what it's about. It's more about what happens during the next few months about the budgets.
But the lead indicators have been a bit soft, right? Headcount addition is negative this time for TCS, and even the order book has declined on a quarter-on-quarter basis. Moshe, would you say that this time the downturn that we are likely to see in ITs? Okay, we'll have to leave you at that. Moshe, thank you very much for joining in. We'll also thank Prakash, Diwan, on that note. The press conference of TCS is about to begin. We've got the top management speaking, so let's cut across.